Our world has gone through many drastic changes that have spearheaded the advancement of global civilization. The rise of the digital era may seem crazy, especially with digital art selling for millions. Yet, believe it or not, we have previous revolutions to look back on that will help us decide what investments are key for the next decade. In this video, I will cover how Cathie Wood, the CEO and CIO of ARK Invest, recently predicted that deflation is coming instead of inflation. Welcome to Casgain's Academy. If you're new to the channel, please consider subscribing for more content like this, and let's get right into it. The stock market has risen by a substantial amount recently, which leaves many questioning whether the stock market is overvalued at this time. One common statistic that investors use to determine whether the market is overvalued is the S&P to GDP ratio. Essentially, what this ratio does is take the S&P 500 market cap and divide it by the US GDP. These types of calculations are often done by many famous investors, including Warren Buffett himself. According to the current S&P to GDP ratio, the market is extremely overvalued, to a point where the current market is more overvalued than the dot-com bubble. Yet, Cathie Wood thinks there's something even larger going on here, which is that the GDP statistic itself has become outdated. However, as you can see in this graph, when we zoom out to the late 1880s, the S&P to GDP ratio makes it seem like the current market is actually undervalued. Yet, if we take a look at the S&P 500 PDE ratio in the late 1800s and early 1900s, we can clearly see that the stock market wasn't as overvalued as the S&P to GDP ratio hinted at. Ultimately, Cathie thinks that the whole system is outdated and will soon change for some major reasons. You might be skeptical right now, as the overall sentiment is that inflation is coming, not deflation. After all, the government has printed a significant amount of money during the pandemic, and this should lead to even more inflation. Yet, behind the scenes, there's a much larger transition occurring with innovation, and innovation always thrives during a crisis like the pandemic we just went through. There will still be temporary inflation in the short term, which was demonstrated in the most recent inflation report with the Consumer Price Index, or CPI. In the recent CPI report, inflation was up 1% month over month. Yet, this was fueled by the base effect, because last year, we were in a deflationary period, which is the opposite of inflation. And because of that, the year-over-year numbers make it seem like inflation is high right now. After all, when you subtract a negative number, you get a positive number, which is exactly what is happening in the inflation reports.
We did get some inflation indicators this week, actually today. The PPI came out. It was much stronger than expected. It was up 1% month to month. This is not a year-over-year number, 1%, so annualized. That would be double digit, and that does sound scary. On a year-over-year basis, I believe we're at 4.2%. So we know that we're in the middle of what's called the base effect. Last year, we had declining prices as we entered the COVID crisis. And the declines lasted for several months. So now, year over year, we're going to be comparing against negative numbers.
Now before we get into that, let me explain why Cathie thinks the S&P to GDP ratio is not a cause for concern. During the industrial age that happened in the 17 and 1800s, the formula for calculating the US GDP became outdated. The problem was that the GDP statistic wasn't including all of the necessary items required to be accurate. Cathie thinks that the same situation is happening in the digital age. Overall productivity is increasing through improvements in manufacturing. For example, Amazon has revolutionized its business by using plenty of robots and replacing the need for humans. Cathie has stated that thanks to these productivity improvements, the real GDP growth is likely higher than the numbers that we see. The real GDP is essentially the normal GDP, also known as the nominal GDP, subtracted by inflation. The reason why Cathie thinks that the real GDP growth is likely higher than the current growth rates is because of a simple pattern that occurs whenever disruption happens. When new innovative improvements to products are created, the existing companies or workforce are forced to lower their prices or wages to compete. When prices are lowered, deflation occurs, which is the opposite of inflation, as the buying power of the dollar increases instead of decreasing. This pattern is seen in many innovations that have taken place in the US, which includes the disruption of almost all old technologies like flip phones. When there's less inflation than reported, the quality of earnings increases, as the dollar is worth more in deflationary periods. The current age of innovation is set to create a huge amount of deflation. Cathie stated on Twitter that the technology-enabled innovation evolving today is dwarfing that any other period in history. It is creating good deflation and explosive demand. Battery technology is a good example. In ARK Invest's view, EVs will scale 15 to 20-fold in the next 5 years. The example of EVs is an obvious example of the type of deflation that is coming. When battery costs inevitably decline and EVs become cheaper, dealers selling internal combustion engine vehicles will have to lower their prices in order to compete. This is clearly seen with the upcoming $25,000 Tesla, which will definitely steal plenty of market share from fossil fuel powered vehicles. Ultimately, the disruption of internal combustion engine vehicles will set the stage for the end of many traditional automakers. When traditional automakers go bankrupt, huge sums of money leave the total money supply, which leads to further deflation. This is because traditional automakers have plenty of debt that they will default in. In the case of a government bailout, significant value is lost for the bond and stockholders, which leads to a substantial amount of deflation. The government can inject money into the economy in order to counter this deflation. But even if that happens, most customers won't purchase fossil fuel vehicles anyway, especially if EVs are much cheaper.
And they were not investing enough in innovation. And so what we're going to see out of those companies, maybe not this year, but over time, is deflation, the bad kind. They're going to have to cut prices to move inventory that is going to become obsolete anyway. And they'll have to cut prices to service their debt. Other companies who are on the right side of change and have prepared for the new world are going to do very well indeed.
Now, we know that deflation created by innovation is likely coming in the near future, but you may be wondering, what impact will this have on the general stock market? When it comes to the general stock market like the S&P 500, innovation technically isn't beneficial or detrimental. There are many innovators in the S&P 500, and there are also many companies in the S&P 500 that will likely get disrupted. In the context of the economy as a whole, the bond market benefits from deflation. This is because when there's less inflation, bond yields decrease. With lower yields, the discount factor decreases. The discount factor is the rate at which money loses value. This statistic is often used to calculate the present value of cash flow. For example, if the interest rate is 5%, then you would likely choose to be given $100 now instead of $104 in 1 year. After all, if you put $100 in bonds, then you will get $105 in 1 year, which is more than $104. In this example, the discount factor is 95% because money loses 5% of its value in 1 year. By multiplying the discount factor of 95% by $104, we get a present value of $98.8, which is lower than being given $100 today. Cathie explained that if deflation limits a long-term treasury yield to low single digits, the discount factor used to present value future cash flows probably will fall to surprisingly low levels during the next few years, a massive head fake in the face of higher inflation expectations. In other words, because Cathie thinks that inflation will be lower than expected, the discount factor will be much lower. When the discount factor is lower, then the cost to borrow money decreases since the dollar maintains its value. And guess which companies borrow money more often? Growth companies. Essentially, the conclusion out of all of this is to invest in growth companies rather than value. In particular, Cathie Wood is warning others to stay away from the value stocks that are going to be disrupted. She stated on Twitter that investors need to get and stay on the right side of change. Yet, after watching this video, you still may be skeptical of Cathie's explanation. Cathie actually thinks that having skeptical investors is completely normal. She explains that the seeds for the explosion in innovation today were planted during the tech and telecom bubble in the late 90s. Back then, investors chased the dream before the tech was ready and while costs were too high. After gestating for 20 to 30 years, the dream has turned into reality. But given the reactions to ARK Invest research, many investors seem skeptical or reticent. This wall of worry is healthy. I would prefer to invest in the face of fear than exuberance. All of this change will shock the world completely, especially those that are skeptical of innovation. However, given that we now understand what's going to happen, we can expect and react accordingly.
So I think the markets, the equity markets and the bond market are going to become confused at these dueling forces. And we're going to be here to help explain, as we see it, how these forces are going to evolve and who's going to win out in the end.
So there you have it, Cathie Wood's warning for the upcoming deflationary period spearheaded by innovation. Let me know whether you think Cathie is right and which growth stocks you're investing in at the moment. If you enjoyed this video, please hit the like button and don't forget to subscribe, and I'll see you in the next one.